we are going to put our accounting transactions through a 3-step process. First, we analyze each transaction to determine what accounts will be affected. Then we record the transaction. When we record the transaction, it has at least 2 effects on the accounting equation. We call this duality of effect double entry accounting. In other words, 2 accounts are affected. Remember that as it is one of the most important basic principles of accounting. After we record the transactions, we summarize the results. For example, we determine in total how much cash do we have. Let's look at a business starting with the accounting equation assets equals liabilities plus equity. If I start a business with nothing, I have no assets, liabilities, or equity. If I then borrow $10,000, I now have $10,000 cash, but I also have a liability of $10,000. I would record that in 2 accounts using the double entry accounting concept. My cash increases, but so does the amount I now owe on the loan. Let's do a second transaction. Now, if I had personally invested $5,000 into the business from my personal bank account to buy stock in the business, I would now have $5,000 equity in the business. I show that as an increase in assets, that's because I got $5,000 more cash, and an increase in equity. And then I would summarize everything and end up with $15,000 cash for assets, $10,000 for the liability, and $5,000 for equity. Assets equals liabilities plus equity. When I analyze these transactions, I would have to identify which accounts are affected. For example, the first transaction increases cash and increases the liability notes payable. The second transaction further increases cash and increases the equity contributed capital. Contributed capital is the amount you personally invest in the business. As can be seen, we end up with $15,000 cash equals $10,000 note payable plus $5,000 equity, the contributed capital. This is how accounting works. $15,000 of assets, the cash, equals $10,000 in liabilities, the notes payable, plus $5,000 in contributed capital. We now introduce 4 new basic accounting concepts and refine our process for recording transactions. For now, we have 4 steps in the accounting process that we call the accounting cycle. 1. Analyze the transaction. 2. Record the transaction in the journal. 3. Post the transaction to the ledger, the T account, and summarize. And 4. Prepare a trial balance. The new concepts that we cover over the next several slides are 1. Debits and credits. 2. The journal. 3. The ledger. These are the T accounts. And 4. The trial balance. In providing a visual picture of how accounting works, we use a depiction known as the T account. Here is a T account. We use a concept that was established over 500 years ago, the concept of debits and credits. The left-hand side of the T account is the debit side. The right-hand side of the T account is the credit side. We set up a T account for all our individual assets, liabilities, and equity accounts. In Chapter 3, we will actually add revenue and expense accounts, and in Chapter 4, we will add the dividend account. These include cash, vehicle, accounts payable, common stock, etc. How debits and credits affect the various accounts is critical to your understanding of accounting. Debits increase an asset account. Credits decrease asset accounts. Credits increase a liability account. Debits decrease liability accounts. Credits also increase an equity account. And debits also decrease an equity account. Remember, the left side is always the debit side, and the right side is always the credit side, regardless of the type of account. Let's show the first accounting transaction we had when we got a $10,000 loan. We will show recording of it in the journal and the ledger, the T accounts. This will also show how we use the concept of debits and credits and double entry accounting. For every transaction, debits will always equal credits. When we get the loan, we increase our asset cash and at the same time increase the amount we owe in our liability notes payable. We record the entry in the journal. The accounting entry is a debit to the asset cash, you increased cash, and a credit to the liability notes payable, you increased the amount you owe. When you post the debit cash for $10,000 and the credit notes payable $10,000 to the ledger T accounts, debits still equal credits. Going from the journal to the ledger is known as posting. Now let's show the second transaction we had when we invested $5,000 in the business. When we invested $5,000 into the business, we increased our asset cash and at the same time increased the amount of equity, common stock. We record the entry in the journal. The accounting journal entry is a debit to the asset cash, you increase cash, and a credit to the equity account, common stock. You increase the amount you have invested in the business. We create a ledger account for the common stock. Then you post the transaction to the ledger. We debit cash for $5,000 and credit common stock for $5,000. Going from the journal to the ledger is known as posting. Equity sometimes is called contributed capital, but from now on, we're going to call it common stock. The total in the cash account is now $15,000. We now go to step 4 and prepare a trial balance. This is a listing of all our accounts as of a point in time. showing the balances and if they are a debit or a credit balance. We have cash of $15,000, notes payable of $10,000, and common stock of $5,000. Total debits of $15,000 equals total credits of $15,000. We use the trial balance to prepare our formal balance sheet. See that on the next slide. Using the totals per account from the trial balance, we prepare our balance sheet showing cash of $15,000, notes payable of $10,000, and common stock of $5,000. Our simplified balance sheet should look like this. Total assets equals total liabilities plus total equity. $15,000 equals $15,000. So far in my lecture, I have just shown a simplified balance sheet in order for you to understand the basic concepts. Now I want to take it a step further and show what we call a classified balance sheet. What is a classified balance sheet? A classified balance sheet breaks down the assets and liabilities into two categories, current and non-current. Current assets are either those assets that are cash or will be cash within 1 year. The three most common accounts in this category are cash, accounts receivable, and inventory. You sell inventory and it becomes accounts receivable. You collect accounts receivable and it becomes cash. Or a current asset could be something that will be used up in 1 year. The most common account that is in that type of current asset is supplies. Current liabilities are those liabilities that you will pay off within 1 year. Here is an example of a classified balance sheet. Note, current assets are $12,000 and current liabilities are $5,000. We use this information to do a quick calculation called the current ratio in business. The current ratio measures how well prepared a company is to pay off its debt that will become due within the next year. Any current ratio of 2 or more is considered good. This is one of the things I always look at when I am buying stock in a company. The current ratio is computed by dividing current assets by current liabilities. From the balance sheet on the previous slide, we had current assets of $12,000 and current liabilities of $5,000. $12,000 divided by $5,000 equals 2.4. A current ratio of 2.4 is very good. It appears that this company will have plenty of cash to pay off their upcoming debts.